Hello and welcome back to the UK SIF Leadership Podcast. I'm Sally, and today we've got a great session planned with Martyn Jones, Fund Manager at Liontrust, on the very important question of can sustainable investing deliver strong investment returns over the long term? Martyn, thanks so much for joining me today.
Hi there, how's it going?
Can we start with you telling me a little bit about yourself, about your role at Liontrust, and then we'll dive straight into the content.
Yeah, so I'm one of the fund managers at the Liontrust Sustainable Investment team, and I joined the team around 11 years ago, our prior parent, and we've been at Liontrust since 2017. And I was an analyst, and then I became a fund manager in 2019. So right in at the deep end, when it hit 2020 with all the COVID pandemic and the difficult choppy markets that we've seen since then. So it's a baptism of fire, and I've been learning a lot. But we've got a fantastic team of people here at Liontrust. There's 17 members of our investment team, and we really take that long-term perspective and stick to a four-part process where we're looking to understand the long-term sustainability themes that are driving markets over the long term, and the companies which are helping to tackle some of our most difficult problems with innovative solutions, and really back those long-term innovators for the long term, and gain the exponential effect of compounding. So that's what our job is in a nutshell. And we've been doing it for 21 years, and we look forward to the next 21.
Brilliant. Thanks, Martyn. That's a great introduction. But let's dive straight in with a question that's really at the core of this issue. So what's been the cause of any underperformance over the past 2 years in many sustainable investment strategies?
Yeah, I think this is a really critical question right now. So I think that for the prior decade, sustainable investment funds and ESG funds, to use that umbrella term, performed very well. We had scarce growth, and we had sort of ever decreasing interest rates, and that environment created a really strong performance background for sustainable investment funds. The last 2 years, that's reversed quite rapidly. And so what really has happened? So inflation kicked off tail end of 21. There was worries about it, and then 2022, it became evident that inflation was becoming more persistent. It wasn't one of these things that was quickly, coming in and going out in the market, and we've been living with that, ever since. Now, what central banks have done is increase their interest rates and the cost of capital to try and quell that impact of inflation, try to get that genie back in the bottle. Now, the impact that has is to quickly, if you increase the cost of capital, that quickly puts downward pressure on valuation multiples. So, if you're saying that a company trading on 20 times PE with a higher cost of capital, that can compress that quite quickly to, say, a 15 times PE. So you have a quick 25% derating. And that's really what we've seen across our funds, really. So valuation multiples compressed. And it's particularly acute when, as I said, we're investing in those companies which are growing for the very long term, more than the market, because they're tackling some of our most difficult problems with innovative solutions. And really what's happened is those companies have been impacted more than companies which are maybe growing less or are trading on a lower valuation. So we're investing in really high quality businesses that are disproportionately impacted. So really, in a nutshell, that's what's happened. The cost of capital has increased quite quickly, and valuation multiples have come down. Now, there's a really interesting study that was published in I think it was the 2000s, and it focused on what drives, performance. So there's three components of what drives a share price. So first we have, your profit growth over time. So per share profit growth. And as I said, that's selling more, that's having higher returns on capital, and it's tackling problems. Then you have your valuation multiple. As I said, a 15 times earnings or a 20 times earnings. That's so the expansion or contraction of that valuation has an impact. And then finally have your dividends or your buybacks, so income produced. So they're the sort of three components of returns. Now, in the near term, when cost of capital increased rapidly, as we've seen, interest rates going from 0 to 5, the valuation multiple is crushed very quickly. So near term, around 50% of your performance in any 1 year is driven just purely by valuation multiple. However, we are long-term investors. We invest with, a minimum of a 5-year investment horizon, and we often hold way in excess of that. On a 10-year view, that same study found that 75% of your share price appreciation is driven by profit growth. So it's not by multiples. It becomes, the longer you go out, the longer your investment horizon, the less important that valuation multiple or contraction matters. It's all about profit growth in the long term. But really, in the near term, it's people are buying and selling shares, and it's a voting machine. And people are selling shares right now in high growth companies, and they are voting against them. And that quickly has the impact of crushing the multiple. But then on the long term, what the market does is it weighs it, and it says, look, this company, if you take ASML, which has been in our European funds for 11 years, 12 years, that company's increased its profits by something like 550%. So that in the long term is much more important than a 25% change in the multiple. It's much more important just that profit growth over time. And that's what we're trying to focus on. So we're under immense pressure right now with performance, which has been really challenging for clients, and we feel for them. But we can never let that distract us away from the long term, the big structural trends in the economy, and the companies which are providing those innovative solutions that will grow profits per share over that long-term time horizon. So it's a long answer to a tough question, but we're kind of sticking to the long-term process.
Yeah, and sort of looking towards that longer term, obviously with commoditizing rallying and political backlash that we've sort of seen in the US in particular against ESG, will sustainable investing underperform over that longer term, sort of looking ahead?
Yeah, I mean, it's hard to say when there'll be a turnaround near terms. It's hard to pinpoint on the exact catalyst that will drive it. And as I said, what we're actually focused on is the next 10 years in those businesses which will deliver. But what we can say, is that we've got 21 themes, and we've got and we categorize them in 3 main buckets. So better resource efficiency, improved health, and greater safety and resilience. Now, what are the things that we can all agree on? It's a very political issue, particularly in America around ESG. But what I think most people can agree on is that we have a finite world with finite resources, and we have an ever-growing population. No one on either side of the political divide would argue with those facts, and we've got a growing middle-class population here wanting to live lives that are more similar to developed world. So what we need to do is become much more efficient with our resource use. So focusing on a more circular materials economy, and being smarter with our water and our energy. These are all things which are obvious, they're observable, they've been happening for a long time, and it's not a big stretch of the imagination to think that will continue to go on in the future. If we think about our next bucket of themes, it's improved health. Now, what you can observe over long-term time periods is that as economies develop, they tend to spend more money in improving healthcare and improving living standards. Again, that's been happening for a very long time. If we look hundreds and thousands of years, life generally improves. Our living standards increase. We spend more money on healthcare, and we come up with innovative solutions to live longer and happier lives. So that's, again, I don't think anybody would challenge that. And then finally, greater safety and resilience. This is a collection of themes such as enhancing digital security. So again, we can see that over long-term time periods, we're spending more time and money online, but with that, the amount of fraud is increasing with that. So we need to make those critical pieces of infrastructure much more resilient to fraud or crime or shocks, such as the financial crisis, or a ticking time bomb that we also see is saving for the future. We can see that the welfare state is retreating, and that the onus is on you as an individual to prepare for your financial future. So again, these are all things that, regardless of the politics, these things are happening. There's conflict happening around the world, tragically again, but that won't halt the climate crisis, and it won't stop companies investing in net zero. So, for example, we can see that companies they're not stopping their investment in becoming more efficient as a company, or trying to give an inferior service to their customers. They're wanting to improve things. And it's where it makes economic sense and long-term common sense that we are focused on, really. So we try to stay away from the politics of it and just look where it makes sense for the world, for society, and the companies which are delivering solutions to that. And I think that that's what, going back to my original point, will deliver long-term profit growth. That's those businesses that we focus on.
And I think you touched on it very quickly there, but are companies retreating from their focus and investment in ESG initiatives, such as the science-based targets or anything like that?
Absolutely not. The conversation, we meet with our companies at least on an annual basis. So we speak to these companies and we engage with them on the key issues that we think are going to be really important to society over the long term. So we have our 1.5 degree challenge, where we're specifically speaking to businesses on their plans to cut their absolute emissions, so scope 1, 2, and 3, but particularly focusing on the big emitters in the portfolio and how they're going to be ready for 2030 and 2050 in terms of getting to net zero. And we're looking for our companies to be more ambitious than the 2050 plans. And honestly, the companies the wheels are already in motion. So the politicians can say whatever they want, but I think that companies have a long-term perspective, and they're saying, look, the likelihood is that externalities are going to start to be priced, whether it's carbon taxes or whatever mechanism governments around the world will use. That is going to start to cost us if we're unprepared for this. That's going to have serious financial implications for our company. So they are investing in making their operations more efficient, and they're disregarding politicians and what they say on a near-term basis. These CEOs want to leave a legacy of being prudent and responsible, and leaving behind a legacy that they can be proud of. So we're really not seeing any change in their ambitions there.
It's definitely good to hear. So what are the key long-term themes that you sort of see as delivering growth for sustainable investment?
Yeah, I think we've got a number of key themes, and we love them all. And what we try to do is diversify across all of our themes. But ones which are particularly stand out right now, I'd say, are providing affordable healthcare and also enabling innovation in healthcare. That's been a tough area of the market on a near-term basis. So a number of our healthcare companies, they went through the sort of COVID crisis, providing a number of the diagnostics and solutions and tools and vaccine development. But that was really a one-off benefit for these companies. And markets don't like one-offs, and they don't like cliffs of revenue and earnings. Markets are very near-term focused. One of the benefits is, if you do look longer term, you can get a benefit of the short-termism in markets. But coming back to healthcare companies, there has been a fall off in those revenues from COVID. Now, what we've also seen is that there was a huge investment in the healthcare system over the past sort of 2 years following the COVID crisis, and companies were building up stockpiles of the diagnostics equipment and the different testing inputs to their solutions. Now, what we're seeing is a reversal of that. So not only have you seen COVID revenues sort of coming off, we've also seen what's called the destocking. So companies have built up large stockpiles of equipment and inputs and tests, and now those companies are, instead of having say 12 months worth of inventory for drug manufacturing, for example, they're now running those back down to more of a 6-month stockpile of inventory. As you know, we basically have addressed most of the supply chain problems we had in COVID. So those companies, as a consequence, are really cheap right now. So after a period of being really expensive in the COVID crisis, they now, they're right out of favor with the market. And those companies which are making healthcare more affordable, or enabling innovation in healthcare, we think are really compelling from a valuation standpoint and from a long-term growth standpoint. So if you think that we have a global population of over 60s, which is going to double between now and 2050, and an over 75 population that's going to triple in absolute terms between now and 2050, that's a huge tailwind of growth. And we still have lots of chronic health issues that we can address now. We can have personalized medicine, cell and gene therapy. We have the ability to treat so many more indications and illnesses that we couldn't in the past. So that again is going to be a fantastic seam for us to sort of mine over the coming decades. And now is a great time to be looking at those businesses. Maybe another theme, which again we think is going to be really important, is improving energy efficiency. So as I said, the climate crisis is not only, it's driving a shift to electrify the economy and moving away from fossil fuels as a primary energy generation, but we're also going to have to be much smarter with our energy use, and the abundance of energy is not going to be where it was in the past. So I think what we need to do is be much smarter with our energy, and we can see that the industrial companies which are making those industrial processes much more efficient, saving energy and resource use and inputs, they are going to benefit over the long term. So it's again an area of the market that we're excited about.
That's great to hear. And so, sorry, I think we've got time for one last question. So I'm going to ask you, what are you most excited about? So the sort of long term that may have been weak recently, whether that's a company in your portfolio or touching on those themes again or anything along those lines.
Yeah, it's always tough to pick between your favorite children. But I think here's two Swiss companies that I think it could be really exciting for the portfolio over the long term. So back to my innovation healthcare comments and the sort of depressed valuations. Lonza is a company that we're really excited about over the long term. Now, forgive me, I'm going to take a bit of a detour, but if we think of semiconductors for a second, semiconductors are really important for the global economy. And what has happened is they become much more complex and difficult to manufacture. And what has happened is that every company that used to design chips, they would make them themselves. Now, what has happened is they have now shifted to just a few key players to manufacture it for them. It's too difficult to do. It's too expensive to do. So really, the companies have gone what's called fabless. They don't make their own chips any longer. They get companies like TSMC, Taiwan Semiconductor, to make them for them. And exactly the same situation is happening in drugs. So we're moving from a situation where drugs were complex, but they were relatively easy to make. If you think about aspirin, for example, it's a small molecule drug which is relatively simple in its structure and the way to manufacture it. Drugs now are horrendously difficult and complex to manufacture, just like chips. So what companies are doing is the pharmaceutical companies are doing all the research and development, but they're getting others to manufacture those drugs. Lonza is a contract manufacturer for the world's largest pharmaceutical companies. So once these companies have developed these complex, what's called biologic drugs, and they have to go through a really complex, difficult, expensive manufacturing process, they design that. They do that whole process. They have huge scale competitive advantages. They have long-term contracts. And again, all we can see is that the pharmaceutical market going from, say, 30% of those complex drugs, the biologics, to around, it's expected to be about 70% of drugs by 2030. So a huge tailwind. Those drugs are, in the process of being approved. We've got a number of blockbusters already on the market, and Lonza is likely to be a massive beneficiary and is investing behind expanding their sort of factories and their ability to manufacture. So we're really excited about that business, and it's been whacked in the near term. After a period of massive investment, their margins have come under pressure. So if you build a factory essentially, and the factory is 70% full, you don't make huge profits. But as you approach 100% of capacity utilization, you make huge incremental profits, and they reinvest that over and over and over again. So they've gone through a big investment phase, and understandably, their margins are under pressure. But that's where the market, again, is a near-term perspective, but we're taking a longer-term view. Another company that we're excited about is Sika. They are a completely different sector, another global Swiss business, and they are focused on our theme of building better cities. So what they do is make, basically all the construction chemicals that help to reduce the carbon impact of buildings. So we still have a huge urbanization happening around the world, particularly in developing markets. And this company is really increasing the penetration of construction chemicals. And for example, where they're focusing on is reducing the clinker content and therefore the carbon impact of cement. And they've got the best product out there. They've got exemplary margins. And again, they partner with their customers to really develop the next stage of buildings, which are going to have a lower embedded carbon impact. So lots of regulations coming around the world, and that company is going to be an enabler of a lower carbon economy. And one more final one I'll squeeze in. It's a smaller business. It's Trustpilot in the UK that you might have seen.
Oh yeah.
So this is a company that we invested in at IPO, and it's part of our increasing financial resilience theme. So if you think about the way the economy used to be 50 years ago, for example, you'd go into a shop, you'd buy an item, you'd go home, you'd experience that item, and if you didn't like it, you could go back to the shop and you could say, look, I didn't like this. You could tell all your friends, don't buy from this shop, or don't buy this product. You could contact the manager in the shop and have a discussion about it. Now, as the economy has digitized, that interaction is gone. Now, what Trustpilot and the founder found is that the company is trying to address that trust gap in the economy. So what they do is they provide an open, fair, and objective platform for people to leave comments about the product, about the service, interact with the online company, and then enable other people to see, who's the good actors, who's the bad actors, who are the companies that have, fantastic customer service and product, and really directing capital flows to the best companies. And it also helps the companies who, they don't know what they need to improve, so they can engage, they can understand what it is that customers are upset about and really improve those areas of the economy. So we think that company provides a really valuable service, and it's got some fantastic economics by providing this platform service. And it's one that we think is growing in its dominance in Europe, but also now in the United States as well. So again, tackling a tough problem with an innovative solution and deriving really strong economics as a consequence of it. And what we've seen is that in the downturn that we are potentially facing right now, Trustpilot's revenues are they're quite resilient, and it shows you that people really value the service that they're providing.
Brilliant. Thank you so much, Martyn. And this has been a brilliant and thought-provoking session. I think we've covered a lot that I know our listeners will want to hear about. So thank you, and thank you to all of our listeners. Remember to like and subscribe, and tune in again for some more episodes of the UKSIF Leadership Podcast.